Hi, and welcome to another episode of Nursing Your Way to Wealth, where a mental health nurse and an accountant talk about wealth creation, personal development, and financial independence in the UK to help you live the life you deserve. Hi, and welcome back to episode 61. We've called this one Tariff Turbulence just because of kind of what's going on in the markets right now and this real, like, humongous game of chess between the US and China and how it's impacting stock market portfolios. Both Alex and I are back, and we're both being impacted by these kind of tariff changes, and we've both experienced drops in our portfolios. Neither of us are worried. Our plan is to kind of talk you through why we're not worried about that, and also to why it happens as well. There'll be a little bit of kind of finance stuff, a little bit of science stuff, but we'll follow the usual kind of pattern. We'll do a short intro, which is this. Alex read a book whilst he was off last week, so he's going to bring a little bit about that. I've got a really good return on heartbeats. We'll then do the main body of the show, and then we'll give you a short summary. So, Alex, welcome back. I know you had a monstrous week last week. Hopefully, that's calmed down for you. But you told me via kind of message you read or like listened to an audiobook last week. So, if you could just tell us a little kind of what the book is, whether you rate it or not, and like a short summary.
Yeah, sure. And hi, everybody. And yes, so I did read a book. It's called The Seven Myths About Money by Rob Dix. That was my audiobook, and I was listening to that on my commute. The I would start with saying, yeah, I'd definitely recommend it. It was I think it took about 5.5, 6 hours to listen to, and I had quite a different view of looking at money in terms of segmenting it into different buckets, which I found quite interesting. So I guess the fundamentals of the book is the same of most personal finance books. The kind of surround, you don't save yourself rich. You need to kind of detach your time, your earning from your time, um, in order to kind of make real money. And it's all about delivering value. Talking quite a bit about compound interest and that it takes a long time to work. So make sure that you are patient and you start early. And also around, he talks quite a lot about home ownership and to really think carefully about home ownership and whether that is the right thing for you, with the view that actually houses tend not to go up in value over and above inflation over the long term. And so where people are often, I guess, the myths around, my house will be my pension and I've bought my house and therefore that's going to make me rich, then that definitely wasn't the case. And what he was saying, which is, I would tend to agree with him. But he split kind of money into three buckets, so which I thought were quite useful. So one was your protect bucket, one was your maintain bucket, and one was your improve bucket. And so within that kind of protect bucket, that's all about safety and not having any risk. And so the kind of things that fell into there were things such as your emergency fund and a paid off house. And that was your kind of your protection, where you literally, you have a roof over your head and you've got some cash to pay for things in an emergency. Your kind of maintain bucket was then more about your traditional kind of pension, um, investing in the traditional kind of index funds with a view to you grow that over a long time, and eventually that will pay for lifestyle that you have become accustomed to during your working life. And then there was the final bit on the improve bucket, which was essentially, like, in his words, if you kind of want to start turning left on the aeroplane, what kind of things do you need to do? So these were things over and above kind of setting up your protect and maintain buckets, and it's things such as, you start individually stock picking. Do you get buy to let properties? Do you start your own business? Do you expand a business if you've already got one? So it's getting involved in angel investing or investing in small companies. So it's things like that which you can do over and above the other two buckets to start to, yeah, try and grow your wealth and in a kind of life changing kind of way. He does a good job at kind of explaining how different people will, at different parts of their life, will have different risk tolerances, and each three sections of the buckets will may look different. But yeah, I would recommend that as the book to listen to.
Yeah, it sounds like I like the idea of kind of breaking it into these three kind of broad categories or buckets, as he's put it. And actually, I was just thinking about the order in which he presents them: protect, maintain, and improve. I think some people don't do them in that order. They do kind of maintain, improve, protect, or the like exactly backwards. And there's not to say that like that's particularly wrong or whatever, but they're good general ideas of what to do. I mean, I've done them. To be honest with you, I've done maintain, protect, and then merge those together a bit, and then improve later. Um, but yeah, I think if you just get a good handle on most of them, but the bit that kind of strikes me the most is the improve bit. That's very much like creative. There's less risk involved. It's like start the thing that you wanted to start when you were 20, because actually your basic needs, like the base of Maslow's hierarchy, the first couple of rungs are met and they are as secure as they perhaps can be in terms of emergency fund, house ownership, solid start into a pension, and you've got some good investment years behind you. That almost is like coast fi, and then exactly then when you get to that point, you can start doing more creative stuff. Like you can open a sandwich shop that's open 11 till 1, or anything like that. So yeah.
And yeah, and I think as well, what's even just seeing them in those three buckets and then evaluating your current life stage, you might be thinking, oh, I need to just build up a bit of an emergency fund and start putting some money towards a house. But actually, you've speculated on loads of random cryptocurrencies and have nothing saved in kind of an instant access savings account. That's probably the wrong priority.
Yeah. It fits this thing of reward and get rich quick, doesn't it? Which is very enticing for people,
Exactly.
but not, in our
Yeah,
opinion, and perhaps Rob's opinion here, not the safest way to do it. There are always some people who get lucky. It's like playing the lottery. Most people don't win.
exactly.
A lot of people lose for the one person to win. But yeah, it's I've heard of it even before you mentioned it, but I haven't listened to it, and I've got some Audible credits actually, but with my commute being a lot less long now and short, I don't tend to get through many books in the week. I used to be able to get through kind of 2 books solid in a week, like long ones. And now I probably get through like half, maybe. So it just takes me a bit longer to get these things done. But I'll add it to the list. Cool. So next segment, return on heartbeats. I feel like we need some kind of heartbeat sound for this.
Like the theme to Casualty.
So, yeah, exactly, something like that. So, in the absence of having something like that, I'm going to just tap my microphone and see if that does the thing I need it to do. If not, I'll perhaps ask our editing chap Caspian just to figure that out, or perhaps we can, I don't know, buy it or something, or get someone to create it. But let me know, kind of, Alex, what this sounds like, and if it's good, we'll use it the entire time, and if not, we'll look at a kind of plan B. But does this sound like a heartbeat? Or not?
I guess
No.
I think because you've described it as a heartbeat.
Okay, yeah,
Yeah,
yeah.
but
Anyway, yeah,
yeah,
that's basically I just
maybe Caspian can work his magic and find a
yeah,
stock heartbeat thing.
yeah, I think so. Let's ask him that. Okay, I'm not going to do that again. Fine. So, return on heartbeats for this week has actually come from someone, not neither Alex or I. So it's actually a person I spoke to on Reddit. So being a nurse, I frequent some of the UK nursing subreddits, and I saw a post last week about someone saying, do any of you invest about and think about your retirement?" And I was like, "Well, yeah, I do that a lot." And a lot of the posts there, like I would say 90% plus, were like, "No idea about it, never learned it, bit scary. All I have is my NHS pension. Wish I knew more about it." So I started kind of like chatting to people, putting some kind of like responses back to things, and really self-promoting kind of this podcast. And I ended up sending it to about 11 different people over like the course of an evening. And one lady I spoke to a little bit more, called Rose. She had some extra questions, and as a result of our conversation, she sent me another message. I think this morning or yesterday, and she says she's opened an ISA now after our conversation and reading some of the responses on the subreddit. And she set up a deposit of £50 per month after our conversation. And I thought, like, firstly, congrats, well done. That's a great start. And it's just a really good kind of return on heartbeats for her. because it could in future change her financial life, which is massive.
Yeah, I think it's a really nice story, and I think it's and also exactly what the spirit of the podcast is as well, isn't it? Is to help those day-to-day people get their money, get in a better position. It's great that you're on the Reddit and were so proactive in helping to use your expertise.
Mm.
And yeah, huge benefit for Rose.
Yeah, I think it's, to be honest, like nurses are mega busy and they sometimes have variable incomes and they work a lot of weird hours. So like they don't really do the 9 to 5 thing. I do the 9 to 5 thing now, but I used to do all sorts of weekends, nights, evenings, etc. And your brain's kind of a bit muddled sometimes after night shifts and stuff, and you're just kind of getting through each week, I think. And it just doesn't really lend itself to sitting and actually absorbing information like that. So I'd really, if we could help kind of some of the UK nurses sort their finances a bit more better, a bit better, improve it. I think that would be a massive kind of plus, I think, for us. So I'm going to count that as someone we've helped, I think. And she said to me as well, "I'll message you when I maybe sort this out." And I was like, "Maybe's the wrong word. Why don't you think about doing it now?" And then literally the day later, she was like, "I've done it." So yeah, some accountability and some actually really good action. So yeah, well done, Rose. Good job.
Yeah,
Um,
and also I think it just shows it's not that hard to do once you set your mind to it. I think it's
Absolutely not.
setting up accounts and setting up direct debit. The platforms make it very easy, partly because they want your money on their platform and nobody
Yeah,
else's. But use that to your advantage.
yeah, definitely, definitely.
And
It'd be a couple of minutes work for sure.
yeah,
You'd get most of the way there from making a cup of tea and like probably drinking half of it. You
yeah.
could have done that task in that time. So if
And
you're
your future
unsure, have a go.
self will look back and pat you on the back
Yeah,
for that.
absolutely, absolutely. So it's £600 a year going in the right direction. She's paying herself first.
Yeah,
Yeah, huge. So just onto the main body, I think. Yeah, tariff turbulence, global game of chess, impact on the market. What kind of what we think about it? Because I think our thoughts are going to be similar. How we manage it or how we approach something like this, and I'm going to bring a little bit of science around how emotions change or drive stock market change as well. But Alex, do you have any idea off the top of your head how far equity markets are down by as a percentage? I've got 15 in my head, but I don't know if you think similar.
yeah. I'm just having a look now. So I think the since the tariffs were announced, say we film, recording this on the 8th of April. So I think it was say week or two ago. So in the last 5 days, even or the last month, I'm just on my fiddling with my Yahoo app in the
Mm.
background. So the Dow Jones, so that's the top 30 companies in the US, that's down just under 11%. Um, the FTSE, which um, FTSE 100 index, that is down 8.86% over the last month.
Mm-hmm.
Um, got so the Nikkei, that is the Japanese stock market, that is down. So it's 10% over the last month,
Yeah.
15% over the last 6 months. Um, and then yeah, finally on the um, Hang Seng, which I think is China, the Hong Kong is down by 17%. So
17.
some
Yeah.
big moves in not a lot of time.
Yeah, a bit scary, I suppose. I
Yeah,
think if you misunderstand the market. So this is a perfect example of what we call stock market volatility. It can go up and it can go down. We're seeing it go down by some of these figures that we've kind of mentioned. When I simply Googled stock market prices earlier today, I got of the four main headlines, right? I got meltdown as a keyword, bloodbath, falls 1,000 points, and then one other thing said mostly fall, rocky market, in tariff war, and then something else, and a different one was like something has plunged by 5% as like an index fund. Those
yeah,
words sound absolutely terrifying, right? And when we zoom
yeah,
out and we look at the figures of some things, stock markets generally are down somewhere between 8.8 and 17%, as it's like for the last kind of month or so. But when you add those figures, you would think the world's on fire and things are down 98% and everybody's panicking and blah, blah, blah. But when you zoom out and you look at the bigger picture, this will be a tiny blip on those charts as it corrects itself. And a good example of this will be COVID. When that went down at its peak, it was down 35%. So more than twice some of these figures. Um, and when you zoom out and you look over a 10, 20 year time frame, it's just a small V shape. Um, and markets progress like 75% of the time and they go down 25%. In the words of Andy Hart of Maven Money, it's the price of admission. Like these are some of the volatility you pay in order to get outsized growth at the same time. So, Alex, what are your thoughts on certainly some of those headlines?
Yeah, I think the headlines are often very emotive, and
Mm.
it's very clear to see, when it's your hard-earned money that's gone into these, and you see big numbers falling, and you've got the press saying, "Oh, it's a bloodbath, and it's this time is different, and the world's going to change." I think the world is constantly changing. You know, ultimately, we're investing in. If you're invested in the stock market, you're investing ultimately in companies. People like you and me going to work every day to work for companies to essentially figure out ways to make money. And companies are very adaptable. Yes, I think it's a bit of a shock with the way that these tariffs have come in, and in terms of the volume of them and how far wide ranging they are. But I think companies and countries will be able to adapt to them. I don't think it's going to be a quick fix. I think it's going to take a while for it to run through. But the thing with markets is uh, people, I guess the textbooks, if you read about stock markets, everyone's the most logical, rational person you've ever met in your life that then is an investor. The reality is it's humans, and humans are incredibly emotional. We don't like uncertainty. And what's happened is in the space of, week, 2 weeks, there's been loads of tariffs come in, really big numbers, and it's quite unclear what the effect is going to be on all these companies because we're such a globalized world. There's a load of supply chains which are not just in one certain country; they're across multiple countries, requiring ease of access to one another's borders to trade properly. That is changing, but these will run through. Companies will find ways of making this work. And I think ultimately, to your point, you'll look back in 25 years' time and think, oh, yeah, do you remember that? That was when Trump went a bit mad and put loads of tariffs on the world. And,
Yeah,
and
exactly. Yeah. When you're kind of camping somewhere and I'm sipping espresso off a balcony, we'll be like, oh,
yeah,
yeah. Do you remember that episode 61 when we were on like episode 400 and something?
yeah.
Um,
And I think if you take that long-term view, I've got a few, I got a quote from a book here, which I think I've mentioned it before, but I'll just mention it again. Um, So I read this book. I can't remember what it was called. I just took a screenshot on my Kindle. But this company, so Ibbotson Associates, analyzed the S&P 500 since 1926 and concluded that an investor with a portfolio that mirrored the index would have lost money just 14% of the time based on 5-year periods with dividends reinvested. This figure drops to 4%. 4% of people would have lost money over a 10-year period, and there would have been no losses over a 15-year period. And that's going from 1926 till probably the mid to this was to 2019. So almost 100 years of stock market history. I think it just shows the long-term approach that you need to take a long-term approach with stock markets.
yeah. I agree absolutely. We're in it for the long run, like a long time, not a short time. I want to say from reading and a quick Google that book is by Peter Lynch, One Up on Wall Street. Um, yeah, it could be something totally different. However, that is a good book to read. Um, but I think that that's the point of it, isn't it? Like, I'm not worried about the tariff turbulence. You're not worried about tariff turbulence because we've set our finances in a way that means we don't need this money now, being in our mid 30s, or if you're 40s, 50s, whatever. Um, it's actually a useful thing to us because we can buy more stock market units when they're on sale. So right now, everything is between 8 and 17% off.
Yeah.
Um, and it's actually an inverse way that things work. So if you're going shopping and you wanted a pair of shoes or a jacket or something, and the normal price is say £100 or $100 or whatever, and then you don't buy it thinking it's a bit expensive, and then next week you go in and it's 10% off and it's $90 or £90, you're like, actually, this is cheaper, I'll buy it. But when the stock market does that, people become fearful and they don't buy. They're much more likely to go back in a month's time when they're £105 and then be like, oh yeah, I feel more comfortable now, I'll buy them.
Yeah.
And the reason for that is you've said it, like humans are emotional beings. We like it when things are going up and the general moods are good, or the vibe of it is good. We don't like it when things are like going down and people are more kind of fearful. It twigs the kind of the worry part of our brain, which is our amygdala, which feeds cortisol, the stress hormone, and also adrenaline to the fight or flight mode, which is why these sensationalist headlines sell papers. You're much more likely to click a paper, like an article or whatever, to read it that says meltdown, bloodbath, plunge, etc., because it hits those words in our mind and it automatically makes us pay attention. We don't see stories that say the stock market's gone up by however much in the last 2 to 5 years because they're good news stories. It won't sell. We don't see that. The important bit, I think, for me is to not hold news stories so much in your mind. Like what will be will be. Thanks. Bought me some garlic bread. Sorry, my wife's bought me some garlic bread. Yeah. Trying to like sneak her
It's a
way in here.
cameo.
Like,
Yeah.
yeah, that's it. Sneak her way in and put this plate down with some garlic bread on it. But yeah. What was I saying? Yeah, so market noise, right? It sells papers, it gets eyeballs to click newspaper sites, and that's how they make money through advertising, right? So the thing that I do is I'm aware of it, but I don't read into it. I don't want to prime myself to become worried by that. I've got a fully funded emergency fund, which again, as we've said, is a buffer against stuff like this happening. What you don't want to be doing is needing that money and having to sell it when the markets are down.
Yeah, precisely. And I think I completely agree with that. I think see news outlets for what they are, which is they're trying to sell news and
Mm-hmm.
therefore get clicks or get eyeballs to sell adverts and get advertising revenues to pay their journalists. And unfortunately, the factual, dry, kind of scientifically proven or scientifically reviewed articles that appear in academic journals don't sell anything because they're probably they're quite dull and dry, but they're very factual and very logical. That isn't the same as a Sun headline saying about the stock market collapse and how the world's going to the world's going to end because of some tariffs. So I think it's keeping in your mind's eye the fact that you know take a like really long term view of markets. Companies are very adaptable, kind of figure their way around anything. And I think to your point, Alex, you shouldn't be investing unless you've got your emergency fund like nice and to the size that you want it to be and have paid off any expensive debt. I think only after that point should you start putting money in because then you're not needing that money, you're not forced to sell. And it's that old adage, I think, when in times like these, and you hear it from like Warren Buffett and John Templeton, and I think even Nathaniel Rothschild was the guy that coined it, which was buy when there's blood in the streets and sell when there's singing in the air, I think, or something like that. But essentially, buy when others are fearful and sell when others are greedy. This is that happening in action, and it's quite scary to do it because you're swimming against the crowd. You're buying when everyone else is selling. Um, but that's you know, almost use it to your advantage.
Absolutely, and I kind of agree with those sentiments. But it's a difficult thing to actually be tested
Hmm.
in the markets. Like
Yeah.
a lot of people that we see, kind of YouTube message, Reddit, etc. They're like, "Oh, do 100% equity, you'll be fine," blah blah blah. But actually, if you have, unless you have been tested with something like this and you've weathered that storm, you don't know how you'll feel. So use this to your advantage. Test yourself. Check your portfolio. Recognize it's going down. Avoid as much of the news as you can. If you've got any spare cash, now would be a good time to put it in. But just to close the loop, like things are on sale basically now. But to close the loop on the um, like some of the markets going down, the Dow Jones, for example, 11%. Whilst you were talking, I was just doing a little bit of quick Google. Over the last 10 years, the 10-year total return for the Dow Jones, 226%.
Yeah.
20 years, 739.5%. In the last year, 19%, way more than the 11 that's gone down. You didn't see a single news headline that's like, over the last 10 years, this has gone up 226%.
Yeah.
Because it just doesn't sell at all. So, at most, if you've been investing a long time, what this stock market kind of correction or dip or change has done is just lose a little bit of the gains that you've had out of it. It's only really a problem if you retired like a month ago and you've been feeding like using this. But to counteract that, we would say have a good emergency fund in place to prevent you from selling at a loss, or not at a loss, but when prices are less, you can get less for your money. And also, as we've spoken before, Alex, of having a year, 2 years worth of cash on hand for reasons exactly like this. So if you are retired and you've got 2 years worth of cash, you can use that instead of taking money out of the market when the prices are down, and then you can wait that out. Not that I think it'll take 2 years at all, but it then allows that to grow and to continue growing. Or you could supplement. You could get half from your stock portfolio and half from the cash buffer. It's all like we're back to this protect bucket again, aren't we? From Rob Dix's book, you kind of do protect, maintain, improve over your lifetime. And I think in retirement, you can probably start again with the protect, maintain, and instead of improve, perhaps um, like not donate, but do something like you could then give that money to charity, give it to your family, give it to your kids, give it to a library, whatever. Um, yeah,
Or give
something
it
like that.
or give it to British Airways for the first class ticket to Australia.
Absolutely, absolutely. Yeah, do what you want with it for sure.
Yeah. But yeah, I think that yeah, that's all. I agree with all that sentiment, and I think also, I guess if you are approaching retirement, you would probably shouldn't have all of your money in equities. You should have reduced some of that exposure, and you'll have a few more bonds and maybe some other things. But yeah, the point's still the same. That kind of cash buffer for a couple of years just tides you over and avoids the kind of forced sale in certainly when you're starting out in retirement.
Yeah, absolutely. The last thing you want to do is get to that point and need to sell it when the kind of prices are down. Just one last point on this because we're at 28 minutes now, but we've talked before about being flexible in retirement. So if I were nearing my retirement age and this happened, I would be thinking about I'll work another 6 months, I'll work another year, and then or you could find a job for a couple of days a week, just to do something, and then when you have that income from your employment or something, you could spend all of that knowing that you have money in the market and you're just waiting for this period of like choppiness to level out, because it will level out. It's not different this time. If we can handle a global pandemic the way we've handled that, some tariff decisions are not going to make that big a difference. I'll be very, very surprised if they make any kind of more rattling of the stock market than they have. I would view it for what it is. It's a sale of units if you're young. If you have any spare cash, put a little bit more in, especially now that we're in the new tax year. I've put a little bit extra in the hope that it kind of grows over time. I remember back to the COVID times, I put some extra money in, I think I put about 500 something extra pounds in at that point, and I did some maths before. If I'd put in, I had a bit more than that spare, and if I'd put more of that in, I would be much better off now. I wasn't brave enough at that time, so it's a difficult thing, but I've learned from that. And I'd like to think that I would act differently now that I'm better educated on it. Yeah, does that make sense? Like using it as an education,
Oh,
like a lesson?
100%. And I think that's the way to see this. Like investing is a lifelong, pastime and activity. And I think I liked your idea earlier when you mentioned about, advising people, do have a look at your portfolio. You will know it's gone down, but, remember how you feel, take stock of it. And, if I bought some additional shares over um, just on Monday when the tax year rolled, I put some more money in. I see it's really painful to see your money go down, but now it's COVID similar was another um, my first big shock, I would say, in kind of double digit declines, um, and with meaningful amounts of money. But I did the same thing. I just put some more money in, and yeah, was better off for it. So I think it's definitely see it as a learning experience. You know, you don't if you don't sell, you don't lose your money, and you shouldn't be needing that money now. So there's no reason to sell. So there's no reason to panic. Your job is to buy as many units as possible of these things, as regularly as possible for the foreseeable future. And yeah, they are just, you know, 10 to 15% cheaper than they were this time last week or this time last month. And yeah, use it to your advantage to bring down your average cost.
Yeah, absolutely. I mean, what this could be doing now is you're buying things for less, um, and they'll grow in the future. It could be with some smart money moves now, which go against the grain, and it is a bit scary. I get it, but it could mean you can retire perhaps a couple of years earlier by buying cheap now and waiting for them
Mm.
to grow. It's really it's where monies are made. So a lot of the people who really understand investing will be doing just that, which is why you see that kind of V shape in markets. They call it the dead cat, where it bounces when people put money in and it goes back up again. Um,
Oh, okay. I've not heard that before,
oh, have you
but yeah,
not? So
I
after like a
like it. Yeah.
sharp drop, there are people who aren't like savvy investors, etc., who are buying it whilst it's cheap, and it can sometimes cause like a little bouncing movement on the graph. I've heard it referred to as the dead cat bounce.
Oh,
I've
okay.
no idea where that comes from, and I don't know any history behind it whatsoever. And I can't remember where I read it. No, it was one of the early investment books I read. It might have been Tim Hale, Smarter Investing. Yeah, don't know. Um, okay, the the only other thing I'd mention is use it to your advantage, right? If you have any spare money, put it in. If this is concerning you and you're thinking about, oh, I might need to sell some of my portfolio, it means your emergency fund is not big enough, right? So use
Yeah.
this for that. Start adding some extra money to your emergency fund. Pare down your expenses if you are concerned, and just really take stock in where you're at in life and use it as like a grade to like mark where you're at. I When I first started investing, I wrote myself a 1 page financial plan to do with the stock market, and I read it the other day, and it's from what was I 31 or so, so it's from like 20 or something like that, right before COVID. And I wrote, I will continually invest an amount monthly, I wrote an uncomfortable amount monthly, and I won't sell unless my financial plan dictates it. And no tariff turbulence is it's not part of my financial plan, so I'm not going to sell it at that point. And I actually wrote the date and I signed it as well, and I keep it in the back of my notebook. And the other day, my wife, who's bought me this lovely garlic bread that I haven't eaten yet, she said, "Can we get rid of it?" And I was like, "No, it's got a plan in it." She was like, "What plan?" And I was like, read the back page. It's got like a single page plan in there, and it's actually quite affirming to read that because it's held true ever since I wrote it, and it just means that I feel like I'm on the right path.
Yeah, I think that's really good. And I think there's something about writing something down,
Mm-hmm.
which then makes, I'm similar. I've not written like a contract with myself, but I've certainly write, like my portfolio goals and the asset allocation that I want. And why, and I always could just refer back to that, and it's like put together a plan of how much I'm going to put in every month, and it seems to, yeah, I seem to either do that or overachieve it. But I think if it wasn't written down, it's very easy to, I don't know, it seems to go into my brain more
I think it
by
does.
writing it.
I think it does, which is why
it
journaling is very helpful. But when you made that financial plan, you were thinking, firstly, smartly, you're thinking with a clear mind, and you're not thinking about newspapers having words in it
yeah,
like a meltdown, a bloodbath. You're
yeah,
thinking like with clarity. And when you look back at that, you're like, actually, that's my handwriting, and that's my date, and that's my signature, and this is what I've read. So the version of me back in 2019 thought this was a very good idea, and it's been a very good idea up until now. Why am I thinking about changing it because of a newspaper headline? And it
yeah,
just grounds you really back to center. And I think it's certainly helped me when things have been a little bit twitchy, and I try really hard to ignore the market noise of things because it doesn't fit the plan that I have. So I think just writing some notes like that to yourself and like your portfolio goals, Alex, you've noted as well. I think it's a useful thing.
yeah.
Yeah.
I'd agree, and I would encourage everyone to do that.
Yeah, write it down, stick it on your fridge, or stick it in the back of an old brown notebook. Okay, anything else you'd want to mention, or do you want to do a quick summary?
No, I think that was everything. So I can give a quick summary. So I read the Seven Myths About Money by Rob Dix, and I would recommend that people give that either a read or a listen. That's a really kind of similar content to most books, but kind of a bit of a different way of looking at things. We then went on to the Return of Heartbeats, where it's a really nice one this week, where having a after a conversation with Alex on Reddit, rose up and an ISA and started to deposit £50 a month towards her investments, which is a brilliant start to a financial freedom. And then in terms of the main body, we were covering stock market turbulence and in particular the tariffs that have come out over the last couple of weeks, which is leading to quite a lot of uncertainty. See, people are very emotional. Markets are run by emotional humans as opposed to robots. And as a result, we're seeing quite a lot of sell-offs. There's a lot of uncertainty, people rushing to safe assets and not wanting to be in the stock market. But this is par for the course, happens multiple times. Over the long term, there's very small chance that you're going to lose money as long as you stick to being invested. One thing which I didn't cover, which I wanted to, which relates to this, is I did read a book. Oh, that might have been in Rob Dix actually. They did a study of, I think it was like one of the big asset managers to look at some of their best performing investors, like personal investors, and they had one thing in common, which was they're all dead, and that just meant that they were not picking on selling and buying their portfolio a lot. They were buying
Gold medal.
and they'd hold and held it. And yeah, so it's a good chance now. It's a new tax year, so happy new year, everybody. And yeah, start building up that, using up your ISA allowance and stocks, which you need to be buying more of, and buy as many as you can for as cheap as you can. This time presents a very good opportunity to do that.
What a lovely summary. I've also heard that the best investors are dead before. I think it probably is in the
Yeah,
Rob Dix books. I read an interview with him, and he mentioned a little bit of it there. It basically means you just
yeah,
don't mess with it, do you? You leave it to run its course.
exactly. You just you just leave it be, and I think it was Fidelity. It was, yeah, their top performer, like retail investors at Fidelity. Yeah, they'd uh, done brilliantly well, and yeah, they're all
Yeah,
dead because they can't fiddle.
forced to
They're
leave it
just
alone.
exactly
Yeah.
right.
The only thing you missed out of the summary is I got a garlic bread delivery halfway through.
You did,
Yeah,
yes.
so I'm going to eat that. Alex, we'll reconvene next week for episode 62. Thank you for your insights and your thoughts. And yeah, we'll go from there.
Likewise, and thanks everybody for listening. And yeah, please share with anybody that you feel would benefit.
None of what we discuss on the show is to be considered financial or health advice, and we recommend you always do your own research or consult an independent financial advisor or a doctor when making your financial or health decisions.